It's confirmed that APRA, the regulators, are coming in to really slow down this housing boom that we are seeing in Australia. In this video, what I want to discuss is why this is important, what's actually happening behind the scenes, and how this could actually affect you with property prices and how, it could move up, it could move down, but let's just break down what that really means. If you're interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, the thing is, with a lot of this housing information, everyone's like,
oh my God, yeah, housing prices are going up. They keep going up and it'll never slow down.
Now, what I have said the whole time is, yeah, we will see bumps in the road. We'll see speed humps, but I think we know where it's headed, at least for the next part of this cycle. So am I concerned by the housing crackdown and, home loan crackdown? Not really. I think it's actually a really good thing and a fundamental thing that we needed to bring into the economy. So what I want to do is discuss what happened last time APRA got involved and what that meant for housing and property prices. And it might be an opportunity for some of you guys to actually get into property now and buy something without investors just swooping up everything. Home loan crackdown appears imminent as Treasurer regulators discuss house pricing surge. The Treasurer has given the strongest indication yet that home loan crackdown is looming, confirming that surging house prices were a key topic of discussion at regulators' meeting on Friday. The typical Australian home has seen its value climb more than 18% over the past year, with some cities and many regional areas seeing even larger price jumps. Fueling the rise in prices has been an increase in debt as record low interest rates have made larger home loans more affordable. So what we're really discussing here is that yes, the house prices are going up because they're fueled by low interest rates. What that really means is that before, when you had a 4% interest rate on a $500,000 property, your repayments are still the same for $1 million property at 2%. And that's effectively what's happened. And that's what really is fueling this property mayhem. The total value of monthly home loan approvals, excluding the refinancing of existing loans, jumped by more than 2/3 over the past year. Now, there's key points here. Treasurer Josh Frydenberg says the Council of Financial Regulators discussed the recent surge in home prices last week. Analysts expect the council to announce new home lending restrictions before the end of this year. And the last time home lending rules were tightened, property prices fell, especially in Sydney and Melbourne. So that's what we're really going to discuss, is what happened last time, what we can learn from that, and how do we position ourselves for, being in the best position moving forward. Now, architects of the latest housing boom, the Reserve Bank, through record low interest rates, the banking regulator APRA through looser lending standards, and the federal government through its home builder stimulus scheme, have met to discuss what to do about it. Last Friday, I joined the Council of Financial Regulators to discuss a range of issues, including the state of housing market, which is a particular focus for both APRA and the RBA, Josh Frydenberg told the ABC in a statement. We must be mindful of the balance between credit and income growth to prevent the build-up of future risks in the financial system.
Interesting.
I'm sort of going to take a bit of a macro view on this one. I think it's interesting to think about how we potentially have an election next year and how this could play out with housing affordability. And is this the government that really wants to be known as the one that just let housing prices run rapid and it just went crazy? And now you've got so many people, voters, can't actually vote for you in because you're like,
hey, you screwed us over.
And now maybe this is a play for that. I'm not sure, maybe just putting it out there. Mr. Frydenberg noted that early stages of this boom were skewed towards people buying a home to live in themselves. A positive feature of this housing cycle compared to that of the last is a high proportion of first home buyers and owner-occupiers entering the market, he observed. With Australia's economy well positioned to strongly recover as restrictions ease, it is important to continually assess the appropriateness of our macroprudential settings. That is very key, and we're going to jump to a few graphs in a bit, but essentially the last housing boom was really driven by new investors coming in, whereas this time around with all the stimulus that's in the system, it's really been owner-occupiers that are driving this market. Now, some people will say it's riskier having investors with, large loans, and they're really the ones that are pushing prices up. But those loans are actually less risky, in my opinion at least, because that debt actually has income that services that debt, okay? Now, yes, granted, if you purchase like 6 of those and then you've got 3 people missing, like 3 tenants missing, well, now you're up shit creek because you can't afford to pay the repayments. But that's where it's key. I think the bigger risk is the people that are spending way too much, way above what they can actually afford, and there's no difference between a tenant leaving and then you losing your job, which both are very likely to happen. In fact, I would go on to say that if you've actually purchased well and you've got supply and demand constraints, that ratios really works out for you with low vacancy rates, well then it's actually a safer play when you've got investors taking on that property and there's tenants in there providing you that income versus your job security. I mean, does anyone have job security anymore with uncertainty of COVID and the restrictions that are in play? I don't know. Aside from the economic recovery, however, a change in the composition of property buyers during 2021 also seems to have policymakers concerned and considering regulatory action soon. While the borrowing boom was originally led by owner-occupiers, lately it has been investor-driven, driving the growth in new loans. The most recent July figures showed new loans to landlords had risen 1.8% over the month versus a fall in owner-occupier lending and almost doubled in the value from a year earlier. So we can see this here, this graph here. We've got the light blue, dark blue, and we've got the, I guess, mustard color. So the light blue is obviously total, right? So we've got total refinancing. Then the owner occupier is the next one up. And then we have investors. Now you can see it's really kicked off around here, which, if we're saying that's July 18, this is July 21, it's pretty much halfway through 2020 is when all of this started off. But what we can see is a bit of a tapering off towards the end. And again, we're in July. So as of recording this video, we're at the end of September. So if this trend has continued, we've already seen a slowdown. And I think all the data that's coming out has seen a slowdown in the property price growth. And that's purely because, things become more unaffordable and you've gone from, people going in and buying cheap, undervalued properties. And now they're at a point where they're like, well, it doesn't really make sense for us to go spend that much because the yields have compressed as well. What is to be done? So what are the macroprudential settings the Treasurer refers to and how might they be changed? In simple terms, they are the rules the banking regulator APRA sets for the financial institutions it oversees about how much money they can lend and who they can lend to. The last time Australia had a big property boom between 2012 and 2017, mainly concentrated in Sydney and Melbourne, APRA specifically targeted the property investor segment driving the market. The first measure introduced, announced in late 2014, was a 10% cap on the annual investor lending growth, along with a move towards using bigger buffer when assessing the loan applicants to ensure they would cope with the interest rate rises. So just to give you an idea of what that actually means, is that APRA came out and said to banks, well, look, so there's going to be a cap of 10% lending growth on your investor market, right? So if you were giving out, say, 10 loans this year or $10 million worth of loans, in the next year, you were capped to 11 million. So you had 10% as a growth there. So that was the first initiative they brought in 2014, and they also brought in bigger buffer rates. That's essentially where the bank is actually assessing your serviceability. They go,
oh, well, your interest rate is 2%, but we're going to put in a buffer of, say, 2 extra percent.
And that's the difference. And what they do is they base your repayments on 4% rather than 2%. Back then, they didn't have as many big buffers. And so when they got introduced, it's important to see what actually happened because I don't think it worked. The second measure in March 2017 was a 30% cap on new interest-only lending as a proportion of all new home loans. So this is not just for investors. This was interest-only versus interest plus principal. As we already know, if you go interest-only, your repayments are significantly lower than interest plus principal, which meant you could actually go out and you were like,
well, I can afford to borrow a lot more because of my weekly pay.
It doesn't feel as much. So you could go out, take up a loan and, it didn't really affect your day to day. But what happened was in 2017, in March 2017, they came out and they said, well, there's a 30% cap on how many new loans you're bringing out that will have interest only versus interest plus principal. So for every 10 loans, there can only be a maximum of 3 loans that were taken out as interest only. But CoreLogic head of research Eliza Owen, along with most other analysts, expect different measures to be adopted this time. Given investors still proportionally make up a low proportion of housing finance, 29.1%, is below the decade average of 35.1%. It makes sense that the nature of macroprudential regulation through current cycle would be different to what was observed through the previous cycles in 2017 and 2012, when investor participation peaked at 45.2%. So this is very interesting to see that the last housing boom was really driven by those investors coming in, have investors now, but is still at a decade low of 29%. So how are we going to have different APRA regulations that come in, and how is that going to affect the market, especially for investors? Most analysts expect that this time APRA will target debt to income ratios probably by limiting the proportion of loans that can be made above 6 times an applicant's household income. I've mentioned on this channel numerous times that the number one reason I think that could cause, the housing boom to end is debt to income ratios. It's not going to be, interest only loans, interest plus principal loans. No. They're going to go, well, let's just target debt to income ratios. And what that essentially is, your debt, the amount that you can borrow as a multiplier of the income you generate. So if you generate $100,000, the debt that you could actually take on would be 6 times that or 8 times that. And that's what the debt to income ratio is. That's what they're trying to look at here. And you can see that means that you can't really look at financial freedom through real estate alone anymore. That's why I say, I'm making videos about crypto, I'm making videos about Pokemon cards and trading cards, and some people just laugh it off and they don't even spend time watching those videos. And the reason I say spend time on it, really learn about other, asset classes, is because in the next couple of years, when they do bring in harsher debt to income ratios, when they bring in more buffers, it stops you from actually going out there and buying more property, taking on more debt, which means if you suddenly need, say, 7 properties at a, valuation of say $2-3 million, well, now you can't do it because the banks won't let you borrow. Now what do? You put your hands up and go,
well, I can't get to financial freedom anymore. I should have just watched those videos from like 2 years ago.
These loans now account for 22% of new mortgages, up from just 16% a year ago before the latest boom. So for example, if you earn $70,000 and your partner earned $30,000, it would become much harder to get a loan for more than $600,000. So that's exactly what I'm saying. 100K, so 70K plus 30K gives you a 6x multiplier, which gets you the 600. This is something the Reserve Bank of New Zealand is actively considering in conjunction with limits on low deposit home loans and government action to end negative gearing introduced earlier this year. Now, an update to this is what they are doing in New Zealand, because their growth in property has been insane. I think it's averaged out to be like 26% in the year. So what they're doing is they're essentially going, well, let's scrap things like negative gearing. Let's scrap things like interest deductions. So you can't claim those interest deductions against your tax anymore. And I think that's slowing down a lot of that investor activity. It could be things that we introduce here as well. The International Monetary Fund last week urged Australia to make a similar move. Macroprudential policy should be tightened and lending standards closely monitored. Options include increasing interest rate serviceability buffers and instituting portfolio restrictions on debt to income and loan to value ratios. A debt to income limit has also been hinted at as a likely option by financial policymakers themselves. Unlike 2014 and 2017, the concerns this time are not specific of lending such as investor or interest-only lending, so the tools used at the time are not really appropriate at this time, said Reserve Bank Assistant Governor Michelle Bullock in a speech last week. Why are regulators likely to step in? You may think it's all about slowing runaway house prices, but ANZ senior economist Felicity Emmett said it's not. Interesting. What does she say? Those sorts of house price rises tend to mean that we can see big increases in household debt. The regulators are not trying to target house prices per se, but to address the risks around rising household debt. She said that a move to crack down on high debt to income lending is not primarily to protect the banks from potential defaults, like those we saw in the US subprime mortgages that led to the global financial crisis, but rather to safeguard the economy. The issue for regulators is not about banking stability, but is about macro stability in the event of an economic shock, when households are more likely to pull back sharply on spending if they are heavily indebted. What will macroprudential rules do to house prices? So this is the graph that I wanted to refer to. Looking to the past, 2012, 2017 saw extended periods of strong dwelling value growth, and amid falling interest rates and macroprudential measures, probably had the effect of cooling housing market conditions indirectly through tighter financing conditions. So we can see here, the monthly changes in national dwelling, so this is the increase in value. So this is the first round where they had that 10% limit on investor credit growth, and it really did nothing. Then we had the second round, which was the 30% lending on interest-only lending, and that really came down. And then obviously we all got spooked with the Banking Royal Commission, which was a complete waste of time, did nothing. But we did see that complete downturn, and that's when things just calmed down. But now we can see how far ahead we are in terms of growth compared to that. But the thing is, this isn't just about, oh, well, we're seeing growth because, interest rates are so low, and we're seeing this growth because APRA hasn't stepped in and the RBA is not doing their job. No, that's definitely not it. It's in fact, the reason why we are seeing this growth is because the devaluation of our currency. If you simply print more money and give people money to sit at home, what do you think is going to happen? Some people are getting richer than they've ever been during this COVID, restrictions and lockdowns, whereas others have really suffered. So It's not an issue around, oh, well, interest rates are low, that's why housing prices are going crazy. No, it's maybe the fact that you guys aren't letting the market do its thing. Let the natural cycle take its play. We should have absolutely collapsed. The whole housing market should have collapsed last year, but it didn't. Why? Because they just printed out more money and thought, hey, well, housing is going to get us out of this mess. So let's just go with that and just pump money into there. Let's get the housing grants. Let's get housing grants on housing grants, and then housing grants on housing grants that got the housing grants. And let's just call them different names. That's essentially what happened. And then we had this huge amount of growth, and that's essentially why we are here today. Now, I don't think this is a bad move. I do believe it's happening a lot earlier than expected, but that doesn't mean we suddenly see house prices completely fall, 30% drops and things like that. No, I think what's going to happen is we see that slowdown, a natural slowdown, which starts building out more of a foundation. And it also means you don't have shitty borrowers who are going out there spending so much money, more than they can afford, ultimately going,
well, everyone else is buying, I may as well buy as well.
And being emotional about it. Now they're going, okay, housing prices cannot go up forever. I've realized that they can make these changes, they can do things apart from the interest rate. For me, I know my money's working a lot better when it goes into real estate, and I personally like rent vesting. So I go out, I rent somewhere and I invest in other places where the numbers make sense. At the end of the day, investing in housing is not about, well, getting emotional about the purchase. If you are actually investing, if you're buying your own home, one would think you're getting emotional about the purchase. You like what the kitchen looks like, that's why you live there. But when it comes to investing, we're really just applying too much emotion for something that is just a financial vehicle. Now, at the end of the day, is this going to make a huge difference? I think it'll slow down things, but I don't think it's going to be a massive difference. There's too much money in the system. And I think this might be, say, round one of a potential round 3, round 4 sort of measures that they will bring in over the next couple of years, because they don't want to go too hard up front. Because this could just, backfire and we start slowing down the whole economy again. And that, defeats the whole purpose of what we've just done. So that's my thoughts on this. I know it's a bit of a long video, and I do appreciate you staying all the way through. If you have enjoyed this video, drop a like for the video, and of course share it with someone that needs to know, or someone that might be panicking and going,
what the hell is happening?
So maybe they can just watch this video and just chill out. But until next time, I'll catch you guys in the next one. Thanks, guys.